Okay, so we have 2 more weeks before 2022 ends. And actually, I will consider the coming week the last week, okay? Even though I will be still around on the 26th of December to 30th of December, I mean, I don't think there will be much market movement. So the final big movement may happen in the coming week, if there's any big movement at all. So we have is it quad reaching? Quad reaching is already over. So even for the coming week, right, we may have a muted market, okay? But for us, it's relevant because we have CarMax and Carnival Cruise earnings coming out, both earnings coming out in the next week, okay? So we do need to monitor next week for a while. Okay, so since we are very close to the year end, right, let's discuss all the macro data, everything. We have the post CPI come out already, FOMC come out already for the final FOMC for this year. So now let's discuss what we have actually seen so far for the entire of 2022. So where are the folks who say we can go all-time high end of this year? all nowhere to be found, really. It's like from as early as March, I was saying like, no, please, no all-time high. Please don't stop the joke. I can only laugh so much before I die from suffocation. There will be no all-time high this year. And I also believe there will be no all-time high next year, okay? So I think this year and next year we will still be in a very bearish market. So let's start. Setting the tone for 2023. So now that we have properly traded a bear market, right? So if you have been with Nimbus Capital for 2022, congratulations, you know how to trade a bear market already. Next time you see a bear market, you know what to do, okay? This experience will stay with you for life. While everyone else bear market, they just average down, back holding, they don't take the opportunity to learn the market. But now you have taken the opportunity, you have seen my trade live all the way from January until now, right? You know how to handle future bear market, okay? And of course, it's very important since bear market doesn't come often. So maybe the next bear market might come like, I don't know, 7-8 years later, and those who just stay out of the market, those who just average down, ignore the market, right? 7-8 years later again, they might like lose all their portfolio again. So it's always a vicious cycle, okay? Let's start. So firstly, let's look at inflation. All the inflation data that we've seen so far. CPI actually peaked in June at 9.1%. And CPI dropped below expectation for October and November at 7.7 and 7.1% respectively. So this is 2 months of back-to-back CPI drop below the expectation. And it's actually considered very good, very good. In terms of cooling CPI, right? This is actually, I would say a very good result. Okay, so clap to Jerome Powell and Federal Reserve. And we have also seen PCE peak in June at 6.8%. Currently, I think it's like 6.0%. PCE dropped a little slower, okay, due to the way it is calculated. So overall, in terms of inflation, right, October and November data are very strong evidence of cooling, okay. So with that said, right, let's go to FOMC meeting. So in FOMC meeting, what do we have? We have very aggressive. We still have aggressive tightening that is taking place. 2023 federal fund rate projection is raised to 5.1% from 4.6%. And then CPI projection is raised to 3.1%. Sorry, not CPI, PCE. PCE projection is raised. Well, let me make that correction here. PCE projection is raised to 3.1% from 2.8%. That is like telling us that Federal Reserve is still not that confident about inflation coming down, okay? And then they raised the unemployment rate projection to 4.6% from 4.4%. So when it comes to unemployment, this little 0.2% is actually a very huge number because a 0.2% on US population is actually don't know how many millions, okay? And 2023 GDP projection is cut to 0.5% from 1.2%. So this is actually our first clue, okay? This GDP cut is actually our first clue that maybe 2023 might not be a very good year lah. Okay. So the question here is, why is Federal Reserve still very aggressive on tightening measure when inflation show clear evidence of cooling? In the last 2 months, right, we have very clear signs of inflation cooling. So why is Federal Reserve still very aggressive? Why? Like anybody want to answer? How come? What's going on here? Like participate. they want to be 200% sure. True. Yeah, inflation is still at 7%. They want to be 200% sure. Federal Reserve tend to make decisions based on data, okay? So there's a data that they are looking at. There's a data that they are looking at which points to the direction that maybe is still not enough. So what data do you think is the troublesome data that they are seeing right now? Yeah, true. Month-over-month decrease. Month-over-month actually haven't decreased yet. It's still positive. True. Okay. Acceptable answer. The main data that is still very troublesome for Federal Reserve is actually the labor market. Okay, the labor market is still very hot. If you have noticed, our press conference for FOMC meeting have emphasized on the hotness of labor market time and time again. In fact, they emphasize this a lot more than inflation actually. Most of the time they will say that, hey, it's good that inflation came down, yeah, but because labor market is still this much, they need to tighten further, okay? And non-farm payroll has been consistently above the forecast. The unemployment rate is at 3.7%, which is still considered historic low level. So the historic low is, I believe, 3.5 like that, but 3.7 is still very on the lower side. And the job report, right? The jobs opening report indicate more jobs available than worker. Okay. So the labor market is actually the last hurdle for Federal Reserve to bring down inflation. So Federal Reserve want to hold the federal fund rate at 5.1% as per December, as per the SCP for December, until they hit the unemployment target to 4.6. So that is their goal. They want to hold the federal fund rate at 5.1, want to raise until 5.1 and then hold it there until the unemployment reach 4.6, and then that is where they will the inflation is killed. And more often than not, right, they need to see the PCE inflation coming down to the federal fund rate level, meaning PCE must come down to 5.1 while they are still holding at 5.1. And then after that, they can reduce together, okay? As they reduce the federal fund rate, the PCE will continue to go down. So there is a catch, okay? The catch here is that can Federal Reserve achieve this without really crashing the market? So there have always been talk about the soft landing. Jerome Powell is still very optimistic on the soft landing. Okay, I wouldn't say optimistic because if you listen to the kind of speech, the kind of tone that he is using when he replied to question regarding soft landing, right? It is his job, okay? It is his job that he cannot outright say we can't have a soft landing. He cannot say that in a public proper. I think if he say, okay, we cannot soft landing ready, it is the same as saying they didn't do their job, okay? It is the same as admitting Federal Reserve fail at their job. So it's better for him to act blur and then the market crash, we have a hard landing, and then at least he can, there's a deniability, okay? He can say that, okay, we try our best, but this is the best we can do. So every time there's a question about soft landing come out, right? He will always say that he will always mention things like we do hope that soft landing can be achieved, but nobody knows. Initially, he always mentioned yes, they can achieve soft landing, but now he's always ending his sentence with nobody knows. They can't predict. So there is a slight shift in the tone, okay? And the fact that they are raising all the Federal Reserve, they are raising the unemployment rate is also a little bit fishy. So actually the bond market, right? The bond market holds the key. S&P dropped a total of 5.32% from CPI high to yesterday closing now, okay? So it went all the way from 4,001, currently now I believe it's at 3,008 something. So that was a very big drop, more than 5% drop within 1 week, which is considered quite aggressive lah. So during this same period, right, the 10-year yield also went down. The 10-year yield actually went down 13 basis points from 3.62 to 3.49 now. And this is highly unusual because aggressive tightening policy by Federal Reserve, it will actually spike the 10-year yield instead of dropping. So we have market dropping close to 250 points. And then within the same period, right, we have the 10-year yield dropping 13 basis points, which is highly unusual. So even the front end of the yield curve, right, even the 2-year yield went down by 20 basis points from 4.38 to 4.18%. Okay, so in fact, right, in the recent week, we have started to see treasury and equities heading down together, and all is also joining the party lah. Okay, so it's like all down, yield down, stock down. So if we look back a bit, right, 10-year yield actually peaked in October 2022 at 4.33%. So that is actually 4 months after CPI peak. So after 4 months after CPI peak, right, the bond trader, the fixed income trader, they start to believe that, okay, maybe this is the high for the yield. Okay, after that, there are a lot of bond buyers coming in. So this falling bond yield, right, it represents two things. Number one, right, bond trader expect Federal Reserve to lower the federal fund rate in the future. And in fact, they are expecting Federal Reserve to lower the fund rate sooner than expected. Okay. And not only that, institutional are buying up bond as protection now because they think bond price have bottomed, meaning the yield have topped. So it is in a way, right, the bond market is kind of calling the bluff, calling the Federal Reserve bluff. It's like saying, now you say you won't pivot in 2023, but we don't think that you won't pivot. You definitely pivot sometime in 2023. Okay, we don't believe you can hold the federal fund rate at 5.1% for the entirety of 2023. And that's the reason why the yields are starting to come back now. So if that's the case, right, isn't it bullish for the market? If the bond market is calling Federal Reserve bluff, right? Isn't it bullish for the market? Actually, no. Federal Reserve will pivot before 2024. So if the bond market is calling the bluff, then Fed pivot should be bullish. But why are stocks dropping left and right? This is because there is also another catch, and the catch is that Fed is not going to pivot on their own terms. They will actually be forced to pivot because of a recession now. And that's kind of where the bond yields and the oil prices are heading now. Okay. So if we look back at all the recent inflation data, right, you can see that all those periods with very high inflation, whenever we hit a recession, right, all these are recessionary period. And most of the time, recessionary period have to do with high inflation also. Okay. And all those without this inflation number, all those without the inflation number means that the economy actually went into recession when CPI is below 3. Okay, when CPI is below 3, they enter recession. But majority of the time, right, you will see that recession is entered when CPI is above the terminal rate. Terminal rate is 2.5%. Okay, sorry, terminal rate is 2%, where the Federal Reserve target. Okay, so you can see the when the recession hit, right, it actually takes an average of 16 months for the CPI to come back down to 2% from the peak. So if we feel that the June's number is the peak, right, then probably CPI will return to 2% by maybe, I don't know, next year, October, like that, somewhere around there. And you can also see that the peak before the recession, right? What is the CPI peak before the recession? 5.6, 3.7, 14.8. So maybe right now, if currently the June data is paid, right, then it will be 7.1. It should be 9.1 now. Okay, I do believe CPI highest reading was 9.1, but it's still a question mark because we don't know whether it will go back up or not. And then after the recession happened, right, what is the lowest CPI average now? Okay, after the recession is actually 0.1. So most of the time after recession, when recession happened, right, CPI went into negative mode. It went into deflationary mode. Okay, so this is the change from the highest CPI peak before the recession to the lowest CPI peak after the recession. What is the difference? So the average is about -6. So if our CPI peak at 9.1, right, and if we deduct this average, right, then it's likely that our CPI will be 2.3% by next year October, okay. But what I want to point out is that recession always bring down inflation. So if you want to talk about Federal Reserve engineering a recession, right, we can understand why also, because it is the only way to bring down inflation in a decisive manner. So you can kind of think Federal Reserve as like either a very incompetent bunch of people who have no idea what they are doing, or they probably know what they are doing right now, but they are acting blur because they cannot admit they are engineering a recession. So depends on how you want to see it, okay. But we have to accept the fact that recession always bring down inflation. So what does recession mean? Recession means that rapidly declining inflation is no longer a good news, okay? There will be at some point inflation goes down and market will crash. We won't have those situations where inflation down, market go up already. Because now inflation going down is going down for a bad reason, which is deflationary already, okay? So if inflation is going down at an extremely rapid pace, like we talk about how the market forecast for CPI going down is very aggressive, right? And if we start to see this very aggressive down move in CPI, it is a sign that we are heading towards recession, okay? So rapidly declining inflation is no longer good news for the market already. And in average recession, right, corporate earnings dropped by 20%. And this is not priced in by the market yet, okay? This is not priced in by the market yet. So the current P/E ratio of S&P is actually at 20.5, okay? And the forward P/E ratio for the end of next year, Q4 2023, is 19.12. Okay, so in a recessionary period, right, S&P P/E ratio can actually fall to 15 to 17 period, okay? So these numbers are these 20% and this 15 to 70% is all using past data. So whenever there's a recession, we look at what is the lowest P/E ratio that S&P hit, how much did the earnings drop, and then we take the average, okay? So the average we get about 20% earnings drop and 15 to 17% P/E ratio at the bottom after the recession, and this will happen after a 20% decline earning. So if we were to calculate, right, if we were to calculate using the EPS and the P/E ratio, right, it will put the S&P target at 2003 to 2006. 2003 will be when P/E ratio is at 15. 2006 will be P/E ratio at 17. So this is actually the COVID low. It's actually slightly above the COVID low, okay? So with all this said, right, what is my personal forecast for 2023? My own one, okay? So you want to believe or you want to believe something else, up to you. But this is what my trade will be based on. So I believe that inflation actually have peaked in 9.1 already, simply because the bond yields are going down. Okay, the bond yields are going down. It is something that lead me to sort of accept the fact that inflation may peak at 9.1 already. But the important thing is that the bond yield going down is actually not a good news. Federal Reserve will definitely raise the rate to 5.1% in 2023. So most likely there will be 2 rounds of 25, one in January 2023, and then the other one in March 2023. Inflation will continue to cool, but market will no longer respond to cooling CPI number, okay? It will no longer respond positively. Market is not going to rally on CPI, cooling CPI number maybe by next year. Next year, maybe March, April, like that, inflation continue to dive, right? Market will no longer respond positively. unemployment rate will continue to go up to the Federal Reserve target, because that is what Federal Reserve want the unemployment rate to be at. And the first quarter of 2023 earnings season, right, which will be released in March 2023, I believe that earning will be taking a big blow where we will start to see the earnings diving down, the 20% earning dropping now, okay? And then market will create a new bottom, but I do not believe the new bottom to be at 2003, 2006. I think that one a little bit too much already. So I mean, the calculation of that number is using PE ratio alone. So that is not a good way to calculate price target. Also, that's like the same as using moving averages, okay? But it can give us a worst case scenario. But I do believe the actual target to be somewhere around 3,002 to 3,003, okay? So maybe in future webinar, right, I will show you how I come about this number. But for today, right, I simply do not have the time to show my working, okay, because I'm giving course today. So this bottom, right, it can happen around second quarter or third quarter of 2023. And Federal Reserve will probably be forced to pivot by fourth quarter 2023. Okay. So I do think that Federal Reserve will be forced to pivot next year, even though Jerome Powell said there will be no Fed pivot next year, but I do think they will pivot next year. But that pivot will not be on their terms. It is not because they want to pivot, but they will probably be forced to pivot after the recession hits. And 2023 will still be overall a bear year. Okay. So this is not a license for you to close eye and short everything. This is just a roadmap on the current data. What we are looking at with the data that we have right now. So things can actually change, and it is our job to continuously monitor macro data to see if there's any changes to the roadmap. Okay. So throughout the entire 2022, right, I have been consistently updating my macro data, looking at all these, the chart here, the chart here, there, building permit, ISM, whatever. Okay. And I have realized that nothing is changing. All this data is still pointing towards a restrictive market. And that is what always lead me to be very confident that every rally is still a sell. So ever since from March 2022, all the way until now, right, I have not changed my view once. Every time there's a rally, it is always a sell. Nothing have changed yet. And nothing is going to change, I believe. Okay. So a long short portfolio is still necessary. Do not hold a full portfolio short, because there will still be some bear market rally coming in here and there. But you can safely hold more net short position now. Okay. So instead of holding 2 net short, you can start to hold 3 net short, 4 net short. But do make sure you still have your long position there. Okay, we will choose our long properly also. For example, in this bear market, we got a lot of long position profited nicely also, like Royal Gold. There was some long position previously. I forgot already. Post holding, WWE, all these kind of counters. Okay, so one thing for sure, market have not bottomed yet. So if anyone else telling you bottom, right? Instead of blindly believing, ask them to explain to you, ask them to show you some data, why they think it is not bottom. And if they start drawing technical line, if they start putting moving averages, you better be careful, okay? you better do your own due diligence. So that's my presentation, okay? So of course, this is what I have right now. Going forward, if data changes, or if let's say there's a war broke out, China go and attack US, all this we don't know. I mean, we cannot account for external shocks that is coming in now. Okay. So now with that said, let's look at the market itself. The market is going down as mentioned now. Okay, so this is no surprise. We even kind of predicted exactly what will happen. If CPI goes up, right, it's highly likely that FOMC will bring the market down. Okay, and show you my current portfolio. I'm using back this. I will change it to seeking alpha next year. Okay. If not, it's very hard to monitor, but I kind of managed to edit here and there to reflect the real value. So you will notice a few things. Royal Gold, I have TP ready. Dealer is still there. Dealer is still there, but dealer actually came down quite significantly from the top. Okay. So right now I'm holding 4 4 shorts and 1 long lah. Only WWE long was there. So Whirlpool short is still there, CarMax short is still there, CCL short is still there. Excuse me, and Dillard short is still there. Okay, so I got 4 shorts and 1 long, which give my which makes my portfolio something like this lah. Okay, Carnival Cruise, CarMax, Whirlpool, Dillard, WWE, and of course we still have VIX lah. Okay, we still have VIX expiring next month, so don't need to be too worried about VIX yet. If by early January we start to see VIX not really doing that well, right, we can do some damage control, and that is where I will teach you some damage control on options lah, where you can start to do a credit spread to get some money back lah. Yeah, it's option there. It's option. But I will still put the data here nonetheless, okay, because it is still profitable. So if I remove all my actual option, right, then you will see my portfolio very red. Okay, so but what I want to show you also is that I want you to focus on the management of the portfolio. Okay, so before the CPI and the FOMC, right, I have mentioned that I will be going into CPI and FOMC with a bearish bias. So I have removed quite a number of shorts. I removed quite a number of longs. I think I removed what's that long? I forgot already. Construction partner. I actually removed construction partner. I leave my Whirlpool there. And then on top of that, I removed Zoom and Palantir also. Yeah, so I did remove quite a number of counters to make my overall position a net short position now. Okay, and in fact I confidently hold on to Dillard also. So as we go into the bearish market, right, you can see that even after I TP my Royal Gold, my Royal Gold actually was somewhere around $2006, $2007 profit. Okay, even after I TP Royal Gold, I'm still up by about 3,007. So there was a period sometime here, right, I was down like 2,000. But even when the market rally, right, my 2,000, my negative 2,000 become like positive 1,000. And then when the market crashed, the whole thing become like positive 5,000 plus like that. And then I have TP'd the Royal Gold. Okay, so overall, my PNL actually went back to the previous high at somewhere around 73K. Hopefully in coming week, the CCL and KMAX can push this PNL higher, probably to like 80K like that lah. I hope lah. So that will make my year-to-date return somewhere around 30 to 35%. This number is wrong because this tracker is unable to account for short position now. Okay, and I noticed some of the close position were wrongly calculated also. So by next week, right? By next week, I will use a proper Excel to tabulate all my close trade for the year, right? And I will review my yearly portfolio and all the trade with you guys next year lah. So at least you can look at what are the good things that I've done, what are the bad things that I've done, and if next year, if this bear market were to be persistent, right, we have learned a lot of lesson this year, and then we make sure that next year we'll be able to perform very well lah. Okay, so I can tell you that even personally for me, right, I have not traded a bear market before. This is my first time trading a bear market. The only advantage I will say advantage lah is I read a lot. I read a lot of stuff. I make sure I have the proper literature knowledge, proper like how the profitable trader are doing, what are the hedge fund trader are doing. I make sure I know all these lah, and I ensure I know how to properly read the macro trend also lah. Okay, so I think that's the only place that I have advantage over you guys in terms of real experience trading bear market, right? Is my virgin lah. Okay, it's my virgin bear market lah. Okay. I don't consider COVID as a bear market though, because it was like drop one time then return already. So we don't really see this kind of bear rally lah. Okay, we don't see this kind of bear rally happen because the first rally is all the way up already. Okay, so I yes, this is a bear market, but it is not this kind of very painful sustained bear market lah. Okay, so with that said, right, let's take a look at some of the charts. And if you are holding most of the recent shorts, right, I don't suggest you to add any more shorts, but I will go through some of the recent shorts that we have taken. So S&P 500, it have broken through here already. So technical wise, I'm not going to go through anything, okay? So you should not be using technical to sort of look at the trend. Overall, the trend is decided by the macro. But if you are trying to enter because support breakdown, whatever, that one up to you. Okay. So next, 10-year yield. You can see that 10-year yield, it is not spiking up at all. In fact, it is lower than the CPI day. Okay. And in fact, the 2-year yield is also diving down. So we have both the front end and the back end kind of like going down really. And the thing is that whenever Federal Reserve raise the rate, right, the front end tend to spike very aggressively because the front end part is the most sensitive to the federal fund rate. And you can see that even the 3-month, even the 3-month yield, right, is actually coming down. It's actually coming down. So we see it kind of like want to spike during FOMC. It went up, but after that it's coming back down. So this is not a good sign. This is obviously not a good sign. This is the bond market telling us that yeah, we are recession on the cards now, okay? And on top of that, US dollar is going back up a bit, but it is still pressurized, it's still pressured by the downtrend. So US dollar slightly different because if let's say a recession were to hit the world, right, maybe US dollar might be slightly resilient simply because every other currency is falling, okay? So we also have Brent and oil coming back down after a period of short rally. So you will see that I have taken a short position on this ETF called the FXI. Excuse me, FXI is a China large cap ETF. Okay, so you have all the, I don't know, all the Alibaba, Baidu, Tencent, all these here. So it is a China large cap. And in fact, I mentioned I have recommended an option on that trade also. So the option expiry is at February 17. Okay, meaning I'm expecting China market to come back down by around February like that. Okay, so regardless of whatever news that happening in China, right? The opening, easing, this and that. Yes, okay, good. The market rally ready, but in fact, right, within China itself, right, things are not really as great as it seems like. In fact, a lot of China macro data, right, things like employment, the manufacturing, the retail spending are dropping very, very bad, going down extremely, extremely bad. And I would say that China already manipulated their data until like very high already. So in fact, the actual situation might be worse. So for example, actually their unemployment data, right? Yes, they can say they are zero unemployment, but they are zero unemployment because they are hiring people for almost little to no wages, standing around doing nothing. Right? So China, in a sense, right, they are a lot more concerned about their face rather than the actual numbers. Okay. So they will do this kind of funny thing. And for example, the whole, like in fact, the whole during the whole CCP period, they lift the entire China out of poverty, right? They didn't really lift the country out of poverty, but what they did was they lower the benchmark for what poverty is. Okay. So by lowering the benchmark, you kind of like lift the country out of poverty. So there's a lot of all this stuff ongoing. And I do feel that this rally is way too irrational really. I think given Federal Reserve rate hike and all this, right, all the US business pulling out of the China market, right, this should be coming back down already. Okay, so I'm actually betting quite big on the way back down. But of course, when I say big, right, it is still within my risk tolerance. Okay, and I'm using option for this also. So aside from that, I don't really have anything much to show you here. We have lumber price going continue to go down. Lumber price and iron copper prices, right? They are a good indicator for overall manufacturing industry also. Okay. This one kind you don't see at all. So let's go into some of the other trades that we have. We see CarMax actually going back down already. So if you manage to get CarMax at somewhere here, right? Congratulations. I think the original CarMax trade was somewhere lower, but if you manage to get that at a higher price, that's a very, very nice buying price. Unfortunately, I personally exited construction partner, okay, but for those who are holding Whirlpool and construction partner spread, right, I think you can still hold on to the overall spread. So we also have Whirlpool coming down quite a bit from the top here. So I think I did mention, I'm not sure, that if you haven't short yet, right, you can still short somewhere around here. And then we have Carnival Corporation starting to fall also. So these are very, very good. And we have WWE like bottoming somewhere here. So that's good news. That's good news. And Dilla also falling 3.6%. Okay, it has fallen quite a bit from the top already. In fact, when the market was here, right? When the market was here, when Dilla was here, I was kind of telling my cost telegram that I feel like averaging up my Dilla shorts, like short one more here. And in fact, I did tell you guys also in one of the webinar, maybe I want to short that. But looking from the risk perspective, I wasn't that confident to pull off. I'm confident to hold my original short, but not confident to add another risk. Okay. So Dilla also coming down. On top of that, what else do we have? We have Louisiana Pacific, the new trade, the new short trade. Okay. I have personally taken this trade also, but I have not updated here yet. So I took this trade on the day that I sent out the trade setup. Okay, it was on 15 December. This trade candle here. So since then, right, it actually fall by quite a bit maybe, but later I'll update. I think this number should be a lot higher. So Black Rock, like slightly green like that. And then Marriott, I'm also looking at Marriott, but I think recently we have enough short position already, okay. We have enough short position already. So for now, we will hold our short position for a while. If you have not entered, right, try go and look at those short positions that were mentioned recently, especially Louisiana, FXI. I think CarMax a little bit too late already. Carnival Corp, maybe you can still go for it. You can still go for the options. The option strike is at $9. Oh yeah, actually it's already in the money. Okay, so you can try for option strike at you buy in the money option now. Okay, you buy in the money option and hope that it goes to like $6 like that by next week. But I think a little bit late for Carnival also. So these are counters that I entered before the CPI release, okay, and they are going down after the CPI. So is the China ETF short available on IG? Most likely you can go and find. So I don't use IG. I currently refrain from using CFD counters really, okay? Because when Tiger gives me access to options, I'm using options as sometimes as leverage, so I no longer use IG or CMC or other stuff, simply because there is a lack of choices over there. You can try though. You can go and try. And if you have not, if you have not opened up Tiger or any brokerage that have access to option, right, I highly recommend it's time to step out of your bubble. So within the entire 2022, I have taught a lot of people to short. There are like many people came to me like, hey, I don't dare to short, I scared to short, and in fact I have to hold their hand and teach them how to short. Okay, so going forward, we have to always self-upgrade, and option is something that we will be going slowly. Okay, it won't be like suddenly I unload all the option stuff to you, but we will slowly move into option stuff. Okay. Yeah, think and swim also good for option. Also think and swim, IB, currently Tiger, they start to allow more option strategy where they will reduce the margin for you. So I think Mumu also doing that, so not bad okay. So overall, right, there will definitely be a lot more shorts trades coming up, but so far, right, with my current portfolio, I'll be holding off my short trade for now. But not to worry, if you miss all the shopping opportunity in 2022, I want you to go and learn how to short. In fact, it's very easy. I will post my shopping guide again on how to what button to press on your Tiger broker and all this stuff lah. Okay, so next year there will be a lot more opportunity. So let's just take a quick look on Singapore market also. Hopefully you guys have gotten out of nano film if you have, because I posted on Facebook that I have TP this ready lah. Okay, and aside from that, we do have very bad market movement also. How's DBS doing? All these are popping out already. AEM, all the China stock that rallies, China related stock that rally now starting to come back down already now. Okay, AEM coming back down, nanofilm coming back down. Where is Franken? Don't know where is Franken. Are there? Franken also coming top out and coming back down already. YZG is the only one that is like doing quite well though, but at this point, right? At this point, I don't recommend chasing now. Okay, it is a little bit dangerous really, and I tell you if this one fall I think this is a very good short opportunity. If this one falls, it will be like this kind of one. Okay, it will seriously be like this kind of one. So look out for it. I'm not sure if Tiger can short YZJ. No, let me check. Let me check right now. Can I short YZJ with Tiger? BS6. Because I remember Tiger don't allow you to short a lot of Singapore stock. Now it's not shortable. It's not shortable on Tiger. So probably if I want to short this, I may put some money in my poem CFD lah. But this one I think is too much already. It's like the Hong Kong rebound like that. Too much already. At some point it will come down. Okay. So and stay away from energy counter already. Also, for example, I will start to stay away from things like Keppel and Sembcorp industry. I feel still quite okay lah, but maybe Keppel I will also start to stay away really. In Singapore, right? I don't really think there's a defensive counter. What used to be defensive also dropped quite a lot. In fact, previously, SATS used to be very strong defensive. UMS also tend to be quite a strong defensive counter, but they are also quite heavily heavily cyclical lah. Okay, so we will start to see UMS also start to fall lah. So be very careful. Be very careful. So with this state, right? I don't really have anything else really. I won't be introducing new trades for this week lah. Okay, just hold on to your CarMax and CCL for the next coming week, and then whatever happened to it, we shall see how. And for next week Saturday webinar, right? I will go through overall my portfolio performance, how I enter most of the trade, and what is the best performing, what is the worst performing, how we can prepare ourselves better for next year, and then you'll be able to see what's going on. Okay, so we will wrap up 2022 next webinar, and then we will get ready for 2023. So also remember, in January, right? I believe second week of January will be our earnings season again. It will be the earnings season for Q4, and I don't know lah. I mean, for the entire of this year, I always say that earnings season will be quite bad lah. Okay, but I do feel that earnings season will be quite bad also in the coming one lah. But of course, we do have all these bear market rally, not because of the earnings, but because of all this fat pivot nonsense lah. Okay, guys. So yeah, only can use CFD to short for SG, which is quite sad lah. Which is quite sad. Don't know why Tiger don't allow they. I mean, counters like YZJ are blue chip, considered blue chip, right? It's on the STI, so it should be at least shortable lah. I'm not sure is DBS shortable. DBS. I can't even find DBS stock here. DO5. No, the DBS also cannot be shorted. Even DBS cannot be shorted. So I don't think there's any counter on Singapore market that we can short now. Okay. So yeah, so I won't be looking at Singapore market until we are able to long again. Okay, when we are able to place long again, we will definitely start to look at some of the Singapore market. So there's a reason why I don't want to catch this kind, because it is easy to get trapped. It's very easy to get trapped. Either you catch and you catch wrongly and then it start to continue to fall, or it will continue to go up. But if you miss this window to TP, if you miss this opportunity to TP, you are gone already. You are gonna stuck there already. Okay. So the risk reward for doing all this kind of bottom picking in terms of your timing, right? It's not worth it. It's not worth it at all. So I don't really like to bottom pick downtrend chart, especially on a using pure technical alone. Okay. So for Singapore market, like maybe some power recently rally also, if you manage to catch here, maybe this one you might get easily trapped at the top here. And we have the king of slow death, which is Singpost, recently rally a bit, rally a tiny bit, like want to give people hope, and then after that it will start to go down again. China Sunshine also one of the counter that is very notorious for slow death. Okay, so don't get trapped into all these kind of like bottom picking plays. You see, you bottom pick here, you are gone already. And then you try to bottom pick here, you are gone already. Or you bottom pick here and then you feel that bullish candle that I can hold. Then you hold, go up, you're very happy. Then after that, it will continue to go down. Okay, so don't needlessly get yourself into this kind of position. Okay, guys. Yeah, Franklin dropped so much. How about IFAS? Let's look at IFAS. Actually, recently IFAS really a lot. Yeah, actually IFAS went up quite aggressive. 69, 70% like that. But this one also, I mean, you have so many counters, right? There's only like one out of like maybe 20, 30 counters that is able to rally enough to give you a good money. Okay. In fact, if you try to buy every counter that rally like that, if you try to buy every counter that rally like this, right? Not every time you are going to get movement like IFAS. You may get stuck into things like Singpost, you may get stuck into things like Nanoflame, even Nanoflame, right? I would say that we are lucky enough. But if you look at a weekly chart, right, it's like there's only this one short window, okay? This one short window. Okay, guys. So that will be all, and all the best next week for those holding CCL and COMEX. Thank you, guys. And remember, 2023. I don't feel bullish. I feel very bearish. So take care of yourself, okay? Take care of yourself. In the meantime, use this Christmas period to learn options and learn how to short if you are not familiar with shorting yet. Have a good night. Bye-bye.